Good morning, everybody. Shane here from the Brookings Home Team, powered by Century 21. It's the 4th of July week. Ready to blow up some things.
Finally feels like summer, too.
Yeah, it does. It does. Yeah, she's a little red from the lake. So don't feel sorry for her at all.
Yeah.
But today, it is, like I said, Monday morning, 8:15. Ready to go here for our Monday morning mortgage tip. As you guys jump on here, please let us know. Give us a heart, give us a thumbs up, and feel free to share this video with anybody else you think would benefit from it here. But today is a episode that was requested from a listener that we had a little while ago, and thought, well, let's just hit it with Stacy and kind of go from there. So what is the tip for today, Stacy?
So the tip of the day is sometimes people are interested in becoming a landlord and purchasing investment property. We went from years ago, it was super easy, right? You just start buying them up, and you can have up to 10 investment properties at once and still be eligible for secondary market financing. Then it got really tight, and it was very difficult to buy investment property. Now it's loosened up a little bit again. The biggest hurdle that people face is for investment property, you have to have 20% down. You get even a little bit better rate if you have 25% down. But that 20% down is the biggest thing that people run into. Sometimes they could qualify with the monthly payment, but if you don't have the cash down, you're out. So that's the biggest hurdle. There are ways you can, you can't just get cash. You can't just borrow the money for the down payment unless it's secured. So some people pull out the equity from their primary residence to use that to put down. That works. Some little different options that we could look at for that. But the biggest hurdle is the down payment. Secondly, the rates are a little bit higher because it is investment property. You get your best rate on primary. So if you're going to live in the house, that's where you're going to get your best rate. But they're not horrible. They're still better than a commercial rate. You can still get a 15, 20, or 30-year fixed, where commercial is going to be more of those balloon type options. So yeah, it's very doable. But again, the biggest hurdle is that down payment that people face.
Credit scores, I'm sure credit scores still play a part, but are they
still, yep, you have to have in that, good to great type of credit score. You can't be in the lower end. That just makes your rate even worse. And then it makes the payment even worse, things like that. But biggest thing, is that down payment. Sometimes people cringe a little bit at the rates, but they're not bad.
Okay.
They're not bad.
And obviously this is something that you can help with on the investment. So if they have...
Up to 4 units. So a 1 to 4 family unit.
Okay.
That's the other thing, I suppose, would be if you find like a apartment building that's a 6 unit, that would have to go commercial.
Okay.
On the residential side, you can go up to 4, but nothing more than a 4 unit. So.
But you can help them both ways with any of that.
Yep.
So perfect.
So.
All right. Well, that's just kind of the tip of the iceberg. There's a lot of information that comes with that. So obviously, if you have any more questions for Stacy, please let her know. Information I will have on the top, on the bottom, on the sides, wherever your device allows you to see that. So feel free to reach out to her anytime, and she'd be happy to talk to you. And if you do have any other questions about this episode or anything else that you'd like to hear about, let us know. We'll answer it on our next episode. So have a safe and fun 4th of July week.
Yes.
We will be back next Monday here, but kind of a short week for some of us, and some of us not so much.
Right.
But we'll see how that plays out.
Back to work.
Get back to work. So thanks again for watching, everybody. Again, have a safe and happy 4th of July week, and hope to see you guys soon. Talk to you next Monday. See you later.
Bye.